Every single day, trillions of dollars change hands in a place you've probably never physically visited, but one that silently shapes your life, your job, and the price of almost everything you buy. Welcome to the American stock market, the most powerful financial engine on the planet. And today, we're going to break it all down, from scratch. Think of it this way. Imagine you own a successful pizza shop. Business is booming, and now you want to open more locations, but you need extra money to grow. Instead of taking a loan from the bank, you decide to sell small ownership portions of your business to the public. These ownership pieces are called shares or stocks. The stock market is basically a giant marketplace where people buy and sell these ownership shares, not just for pizza shops, but for massive companies like Apple, Tesla, Amazon, and Google. In the United States, the stock market is mainly driven by three major platforms: the New York Stock Exchange, the Nasdaq, and the S&P 500. Together, they represent thousands of companies and more than $40 trillion in total market value. So, what exactly is the stock market? Imagine you own a small pizza shop that's becoming really successful. Business is growing fast, and now you want to open more branches. But expansion requires money. Instead of borrowing from a bank, you decide to offer small ownership stakes of your business to the public. These ownership stakes are called stocks or shares. The stock market is simply the marketplace where people buy and sell these shares. And it's not just local businesses. People invest in some of the world's biggest companies, like Apple, Tesla, Amazon, and Google. In the US, the stock market mainly revolves around three major platforms: the New York Stock Exchange, the Nasdaq, and the S&P 500. Together, they include thousands of companies and represent more than $40 trillion in market value. So, how did the American stock market actually begin? It didn't appear overnight. Its story goes back more than 200 years and is filled with major highs, crashes, and comebacks. Everything started in 1792, when 24 stockbrokers gathered under a buttonwood tree on Wall Street in New York City and signed what became known as the Buttonwood Agreement. They agreed to trade stocks and securities only with each other, and that small agreement eventually grew into the New York Stock Exchange. Then came the booming 1920s, a time when the economy and stock market were growing rapidly. But that excitement came crashing down in 1929, when the market collapsed and triggered the Great Depression. It was one of the biggest financial disasters in history and taught the world important lessons about investing, risk, and financial regulation. Since then, the American stock market has gone through wars, economic crises, recessions, and even global pandemics. Yet, time and again, it has recovered and continued to reach new highs. That long-term resilience is one of the main reasons investors around the world continue to trust the U.S. market.
So how does the stock market actually work on a daily basis? The market operates Monday through Friday, from 9:30 a.m. to 4 p.m. Eastern Time. During those hours, millions of buyers and sellers place trades through brokers. And today, almost all of it happens digitally within milliseconds, using apps and platforms like Robinhood, Fidelity, and Charles Schwab. When you buy a stock, you're basically investing in the belief that the company will grow and become more valuable over time. When you sell, you're either taking your profits or limiting your losses. Stock prices constantly move because of supply and demand. If more people want to buy shares of Apple than sell them, the stock price rises. But if more people start selling than buying, the price falls. So, what influences these decisions? A lot of things. Company earnings reports, economic data, interest rate changes, world events, breaking news, and sometimes even investor emotions like fear and excitement. So, how can you actually start investing in the American stock market? Step 1. Open a brokerage account. Platforms like Fidelity, Charles Schwab, and Robinhood make it incredibly simple to get started, even if you only have a small amount of money to invest. Step 2. Begin with index funds or ETFs. Instead of trying to pick individual stocks, which can be risky, many beginners invest in index funds or ETFs that track the S&P 500. This means with a single investment, you own a small portion of hundreds of major companies at once. Step 3. Invest consistently. One of the biggest secrets to long-term investing is consistency. Successful investors focus less on trying to perfectly time the market and more on staying invested over time. Even investing $50 every month for 20 or 30 years can grow into significant wealth because of compound growth. Step 4. Don't panic during market crashes. Market downturns are normal and unavoidable. Prices will rise and fall over time. The investors who usually succeed are the ones who stay patient, avoid emotional decisions, and continue investing even during difficult periods. The American stock market has generated more wealth than almost any other system in history. And the best part is, it's not just for wealthy people on Wall Street. Anyone can participate as long as they're willing to learn, stay patient, and invest consistently over time. Whether you're 18 or 58, it's never too late to start. The best time to begin investing may have been years ago, but the next best time is today. If you enjoyed this video and learned something new, make sure to hit the like button, subscribe for more financial content, and leave a comment below. Have you already started investing, or are you planning to begin soon? Thanks for watching, and I'll see you in the next video.